Our planning and such, but here we are, and we're going to make the best of it. Thank you very much for being a part of our meeting this morning. We've got some great speakers for you. Howard and some bagels are going to be showing up here in a few minutes, so we'll take a pause when he arrives. Let me get to my presentation here. And there we go. So, as you know, today is Veterans Day, which is actually part of the reason why we are at this location. AmeriFirst was closed for the day. Fidelity was nice enough to open up their doors for us at both locations, actually, unbeknownst to them. But for those of you that either have family that have served, or you yourself have served, friends that served, we want to express our sincere gratitude to you and those who have served our country. Wouldn't be where we are today without them. So thank you very much to all of our veterans. Troy, I don't know if you've got anybody else coming here this morning, but I want to give you a chance to say again, thank you, and our apologies for pulling an audible and changing locations on you. But, Omaha.
Some of you get that.
But thank you again for opening the doors, and the floor is yours.
Football fan, I guess. No, welcome. And you know, this is actually an impromptu, also inaugural meeting in this room. Actually, because we moved. Well, at one point in time, this office was next to. Well, no, I think about it. It was a Pinnacle office, but it was next to your office at the Ridge location. But we were in a different part of the building, closer to the bathrooms, for those of you that had to hike around the corner of the bathrooms. But moved here just pre-pandemic with the training room, and it has not been used for this purpose until today. So first meeting in our training room. So welcome, glad to have you guys here. Jen is on her way, along with Howard and several others who are over at corporate office, so that she's coming. But welcome. Just something I saw back there. I thought we always forget about these, but you know, a lot of you know the zip codes around this area, experienced realtors. But for those of you that need or want a printed zip code map, got a few back there. Let me know. I'll just grab one of those for you. Just one of the many different things that we do. So happy to be part of you guys. Business here, and if there's anything we can do to support you from the title escrow perspective or from business development, be happy to connect. So welcome.
Thank you very much. We look forward to seeing Jen and Sam as well. And before I move on, I want to introduce to you two of our newest associates. We've got Heather and Ryan Ball from North Dakota. They just moved down within the last couple of weeks, and they're going to be officially joining our office hopefully in the next few days. So North Dakota, the great white north.
Not, I live in Bismarck and why not?
Oh, okay. Yeah, we frequent both of those.
There you go. So
I was born in Hazen.
Oh, Hazen Villa, yeah, okay.
That's a really
Now
good
that more of us left, there's nobody else in North Dakota.
Yeah, Arizona looks better and better every year, doesn't it? Well, Heather and Ryan have built a tremendous business out in North Dakota, and they're excited for the opportunity to get things going down here. I know we're going to learn some things from them along the way as well. They've done some pretty remarkable things in what we would consider a smaller market, and have dominated really. The Remax office up there has done really well as well, but they're a very important part of that office. I'm sure they're going to miss them. You're not leaving your business behind, but you are certainly in the process of shifting things, and we look forward to supporting when you get things going.
If you guys have anybody that's going up there, we still help. We'll keep our license for at least a year up there.
Yeah, you have a team supporting you back home. Yeah. Same here. Yeah. Thank you very much. Welcome. So as at our last meeting, we had a couple individuals, one of which was a certified financial planner, and we all agree that we got a great deal of information from them regarding kind of how to strategize your finances going into the end of the year, preparing for the new year. And what we got out of that meeting is there was a lot of questions that really pertain to a CPA level of expertise and knowledge, setting up LLCs and, tax structuring and things of that nature that our other desks, understandably, we're not poised to answer, just like you're not poised to answer all questions about mortgages and things like that. We all play in the same pool together, but we kind of do different things. So we enlisted Seth Fink of, I'm sorry, the company name. Focus. I put all this together yesterday. And Seth has been working with real estate agents. He's been working with Kelly McLean for quite a while. It came very highly recommended. Works like I said, works with realtors, understands the dynamic of our business, being a 1099 employee, how to maximize deductions and strategize to get the most out of the money that you work so hard to earn. So Seth, if you and Jim would like to take the stage, we'll hand the mic over to you. The mic is right in front of you, so if you're talking, just do me a favor, speak a little close to it.
Great view of the back here. And I do speak North Dakota, just so you know. I can say you betcha, yeah, really good. Yeah, don't you know? Yeah, so
The question is, do you know Alex?
just exceeded my capacity. So one of the only states I actually haven't been to. North Dakota, made to South Dakota. That's not the same.
Cool. I live there too.
Yeah. All right, so thank you very much. I appreciate the opportunity to be here today. So we are a CPA firm in North Phoenix. We've been in the Valley since 1978. My dad actually started the practice. Actually, Mr. McLean worked with him before I even came on board in 2004. So the real estate business makes up the largest portion of our client base. So between brokers, agents, and investors, this is something that we do every day, all day. I mean, we work with every single client base you could ever imagine, every kind of business, every kind of individual, but more in the real estate space than anything else. We do everything from structuring LLC strategies for real estate investors that have a fleet of rental properties. We work with brokers. We work with out of the country owners, and we have a lot of Canadian clients who came in here in 08, 09, and 10 and bought properties, and we help them with their ownership structures, and they learn how to do it for all cross-border stuff. So it's been a pretty interesting endeavor, to say the least. I've got a whole bunch of different things on this agenda to talk about. I'm going to keep it kind of high level and a little bit more conversational. I don't do a big PowerPoint presentation on purpose because I want to focus on you guys, not on the content that's up here on the board. So if you have any questions or anything pops up, please stop, raise your hand, say, hey, what about this? We'll keep things moving along, but I want to make it relevant for all of you. So you have a particular question that the whole group could benefit from, please ask it. And that way everyone can get the experience from that. So one of the great sheets they handed out for you is our real estate agent deductions worksheet. We've developed this over the years working with agents to try and encapsulate everything for an agent that's possible to deduct. Because I think what happens is people forget certain things may be tax deductible. This also includes particular things for property management. So agents that do some property management, there's specific expenses there as well. Maybe even for commercial agents. I mean, a lot of this stuff is relevant, not 100% the same way. So this list here is pretty all-inclusive. We provide this to our clients. We do it in environments like this to give you guys an idea of what you need to be doing. And the thing to take away from this is every penny you spend on your business is in some way tax deductible, except for entertainment. Okay. Dang. Entertainment rules changed with the TCJA for 2018. And so giving somebody tickets to a show or taking them to an event is the only thing that you guys can't deduct. Now, what I tell clients is feed your clients because food is deductible, meals are deductible. So if you're going to do a big event for clients, feed them, don't entertain them. And then that keeps everything in the deductible space. I'm sorry? Cocktails and cigars. Oh my God, yes. That's not entertainment. That's food. I mean, I drink really good scotch and whiskey. So, but going through everything. So one of the things that's always important to know as an agent is how is your 1099 produced at the end of the year? Is it gross or net of all your deductions from your commission? It's always important to know because every broker does it differently. So it's the first thing I always ask my agent clients is this gross or net? Because if it's gross, then I want your broker statement to show all the things that they withheld from your commissions. If it's net, then we can include those and we go on beyond that with everything that you guys personally pay for. Okay. But that's an important thing to always know how you're being treated in that space. But you can see here, I mean, there's probably a few things that are, I mean, I'm not sure who buys a calculator or briefcase anymore, a digital camera, but hey, it's still there because there are people that still do those things. So use this, love it. I have clients that have taken this and built a spreadsheet off of it. Most of our clients that don't like QuickBooks or something will actually use this and fill it out each year and provide it to us, right? So just use this as a guide for you working with your CPA to get your taxes done and ensure you're not missing anything. Because the deduction you miss and forget about is the one that you don't get to deduct and the one that you end up overpaying taxes on. So it's just a tool for you guys to be extremely thorough in what you do. One of the things that's included on here, if you notice on the top, on the right column, about a third of the way down, is S corporations and PLLCs, right? We're going to talk a little bit more about taxation structures, but it's important to know that there are more tax effective ways to be a 1099 than as a Schedule C. How many of you are working as a Schedule C and not as a PLLC S corp? Okay, so you'll have to reform in the state of Arizona, of course, right? But it have to be in the state of Arizona, you have to be a PLLC, which is a professional limited liability company, and the name of your entity has to match the name on your license. Not every state requires that. We have a lot of real estate clients in Oregon, and they can name it whatever the heck they want, LLC, it doesn't matter. Arizona ADRE requirements are it's your name on your license, comma, PLLC. Yeah, and you guys can do a joint one as well, a husband and wife one, but you have to be very specific on how you name that. They'll actually consolidate your license for reporting purposes at ADRE when you do that. So anyway, so I'm glad to see you're all working as S corp. So that's one big part. I'm still going to kind of address the benefits of that for the people that might be watching the video or not hear that would actually be able to appreciate that information. All right. How many of you actually take your mileage on your vehicles versus your actual expenses? All right. Realtors, on average, drive more miles than any other profession, maybe other than someone that does outside sales and is on the car all the time. Most of our agents will do mileage deduction. Now, remember, the mileage right now, I think for this year is still 57 cents a mile for all your business miles driven. But the actual expense can also be a viable way to handle your deduction. So your actual expense is the business use percent of your gas, insurance, repairs and maintenance, the depreciation on your vehicle, all those sorts of things. And so when you first buy a vehicle, it's always good to analyze which way is going to be a better deduction, mileage or actual expense. And I'll tell someone to look out over a 5-year period. If your mileage tends to be kind of low, actual expense will end up being better over time, especially if you have a more expensive SUV and that sort of thing. Luxury automobiles that are under 6,000 pounds are terrible tax deductions because they're super limited on how much you can write off each year. So often I tell people if you have rather a passenger car and you don't drive enough miles, we still do the assessment, but they may end up doing mileage just because the depreciation is really limited compared to a 6,000 pound SUV. All right. Who knows how much you can write off on an SUV in the first year?
25.
Wrong. It's 25,000. So SUVs actually are fit in a little special category where it's at the accelerated Section 179 depreciation. It was actually a trick question. Section 179 depreciation is 25,000 is the max, but they changed the bonus depreciation rules a couple of years ago. You actually can write off the entire business use of a vehicle using a different method for now. Bonus depreciation comes and goes and comes and goes. Depends who's in Congress, who's voting on tax legislation. They've changed the limits on Section 179, but that's been a constant. Bonus is all about, I want to incent people to go buy things and spend money. So we create this bonus depreciation to say, hey, we can write off more crap than you can with the other accelerated depreciation. So for now, if your vehicle is 90% business use, you can write off 90% upfront of that vehicle's purchase price. But here's the problem. Let's say you're that person that says, I only keep a car every 2 or 3 years. And then you take all this accelerated depreciation, then you sell it. You have to now recapture all the accelerated depreciation you didn't earn. So the computer calculates what would have been the regular depreciation over that period of time versus the accelerated that you took. The difference you have to pick back up as taxable income. And if you decide not to replace that SUV with another qualifying SUV, you now have a tax bill that you didn't intend. So I always want to get in the head of people doing accelerated depreciation is think about how long you're going to own this vehicle and think about if you do keep it less than 5 to 7 years, are you planning to replace it with something else that's another qualifying SUV or not? Because that has to go into the planning. It might mean your current tax deduction isn't as good. It means we're just planning better for you. So it's not always about the here and now, it's about the long term as well. And especially when it comes to vehicles, you have to think out. You you have to plan ahead for that. Or else you're gonna put yourself in a situation like, we had it happen this year a couple times, like, I owe that much. Yeah, you sold your SUV, it took, $80,000 of depreciation the prior year, and you didn't replace it with something comparable. Oops. So, happens.
What about leasing versus purchasing?
Great question. How many of you lease vehicles? Right. So obviously, if you can stay within the mileage requirements of a lease, because obviously anything over 12,000 miles leases get expensive and don't make a lot of sense. It can really work out well. So you can expense the payments on a lease. It's technically up to the business use percentage. You say, hey, my business use is 90%. You can take 90% of the lease payments, the gas, the insurance, all that sort of stuff. That works just fine. For people who like to turn cars over frequently, leasing sometimes ends up being a better tax deduction. But if you go over on your mileage and you end up having to pay a mileage fee when you're done, it can impact. So agents are less apt to lease because of the mileage. If you're running around a ton, 15, 20,000 plus miles a year, you're getting your butt kicked leasing. Just financially, it doesn't make any sense. And if you pre-buy all those miles, you better not buy a car. So give me that look.
He's like, dang
Yeah,
it.
What do you
well,
think?
Yeah, because I feel like I get screwed every time I deal with an automobile in my business. So I did when I was looking at purchasing a vehicle
Mhm.
versus leasing it,
Mhm.
my payment was going to be like $200 or $300 more a month by
course.
purchasing it
Uh-huh.
for like 6 years and 7 years, and my lease payment was going to be a lot less, and then I was going to get in 3 years get a new vehicle.
Right. Do you typically turn cars over frequently?
Well, I had leased them for 3 years.
Yeah,
every 3
so-
years.
So then it works for you, and that's okay. But
I pay through the nose all
yeah,
the time.
well, you're renting. You're just renting the car from the bank, and you're paying the depreciation. So I always tell people, think about buying a brand new car. In most cases, is the absolutely most insane financial decision you can ever make.
It's fun though.
It's a lot of fun.
It's way fun.
Not right now, because you're going to overpay. But generally speaking, brand new vehicles, you lose so much in the first year too. I encourage people, go look in the slightly pre-owned market. Then when you go to buy that vehicle, if you can find something you like with under 25,000 miles, that's not all used up, then the numbers make a hell of a lot more sense. Something to consider. Right now, it's all bets are off until the car market gets back to normal. Under normal circumstances, that's my advice. Right now, it's like you just drive what you have till wheels fall off, but you can't replace it. I'm also a car guy, so I can talk about cars. You want to talk about fast cars, you can do that too. It's whatever you want. All right, so anybody have any questions on vehicles and actual expense and mileage? Yes, sir.
What about the electric cars?
Mhm.
And I mean, are they going to come up with a different cost per mile for you on mileage expense for the electric versus gas?
I would email your senator and ask that question. I don't know, and I've not heard anything about that. I've just heard nothing about that. So the electric vehicles are so inexpensive per mile, obviously comparatively. If mileage deduction can be a super win for someone with an electric car. So I'd say until they do it, 57 cents a mile, cost me that much to operate it.
So you have to replace your battery.
But then if you're doing, if they do actual expense, you can write that off. If you're doing
True.
mileage, you can't.
Right.
So it just depends. Right, because that mileage rate includes gas, wear and tear, depreciation, tires, brakes, everything. So there's no additional cost. The only thing, if you guys do actual expense, the only thing you can do on top of the mileage deduction, car washes. That's about it, right?
I've spent probably $3,500 in 5 years on the Tesla.
Yeah.
Battery has lost 4%. It was almost 100,000 miles.
That's
Nice.
crazy. See, there you go. So battery should not be an issue. And just don't buy a Nissan Leaf because then it would be really quick.
Seth, a couple questions have
Yes,
come in
sir.
online.
Absolutely.
Let me ask one of these. This is from Brian Neugebauer. Question for Seth. I was told years ago when I changed from a sole proprietor to a PLLC, I can no longer use the mileage deduction and I had to change to actual cost. What is your position on this?
That is 100% hogwash. You absolutely, it doesn't matter on your taxation vehicle, whether you're Schedule C, a PLLC taxes a Schedule C, or a PLLC as an S corp, or a PC S corp. The same options apply, right? There's absolutely no issue with that whatsoever. It's just, you just have to document it, right? You just have to be able to prove your business use percentage of your vehicle and all that. Because, yeah, that's absolutely not true.
Thank you.
Yeah. Any other questions? Yes.
The current tax credit for electric car is 7,500, possibly increasing to 12,500
Mhm.
next year. Is there any current read on that, or is that all predicated on the final?
Tax law changes for 22. Yeah.
The final funding.
Yeah, I mean, there's some of that buried in there, so we don't know yet. But remember that the tax credits for electric vehicles only go for the first certain number of units produced. So you go buy a pre-owned Tesla, you get zilch. You buy a brand new one, you have to look, because only through a certain number of production models, it starts at 7,500, it goes down until it's 0. So that if you go buy a Prius now, there's nothing, absolutely nothing. Those have been
Or it
out of
still
credit for
has some.
years. Right, so it just depends on the vehicle. So I encourage people to do is if you're looking at an electric vehicle and you want to be able to get the tax credit, you have to buy new, but you need to research and look and see what credits are available for which vehicles. That way you're educated. We've had clients go buy an electric car thinking they get a credit. I said, why didn't you ask me first? And then they don't get it. I'm like, sorry, I can't force it. I said, it's tax fraud. Can't do that.
Yeah,
So,
the state of Arizona too, the license.
Yeah.
Ridiculous.
yeah, you pay
I
10
paid-
bucks, or whatever.
I
It's
paid-
ridiculous.
I
Yeah.
paid $50 for 4 years.
Yeah.
And I heard that may be changing.
Yeah, I haven't heard anything specific, but there's grumbling. So, because their state's losing revenue. They're like, we need to get a property tax on that too. So.
Oh, you're not getting rid of your mini Corvette, are you?
No, no.
You have a C8? See, who's not your friend?
I
All right.
like scotch and cigars.
Yeah. Howard, where have you been all my life?
Another question came in. I'm assuming this is regarding car payments. Can you make prepayments for next year to get the deduction for this year?
So when you make a prepayment and it's all principal, it's not tax deductible anyway. So when you have your vehicle that you purchase, the deduction is the depreciation on the purchase price and the interest on the note. So prepaying it and putting out a bunch of principal does not create a tax deduction at all. Because if you bought your vehicle for cash, you get to depreciate it. You just have no interest. If you fully finance the vehicle, the interest is deductible as well, but the principal payments have no tax deduction to it. Yes.
Okay, your answer, if it's a leased vehicle, can you prepay? And I don't lease vehicles, but it's just a question.
That's a great question. Our friends at the IRS say, sorry, can't do that because they look for 12 months of payments. I don't care if it's for any kind of business expense. So if you want to front load your insurance expense or something like that, they say, no, you can't do that. It has to be for the calendar year. So you can prepay it all you want, but you're not going to, I mean, if you came to me and said, oh, I made 24 months of payments this year, I'm like, well, give me the 12 months worth because we can't deduct them and the other 12 months you can take next year. If you have the cash you want to get rid of, fine, but it doesn't improve your tax situation. So, yes, sir.
For deducting food,
Mhm.
for clients
Mhm.
and so forth, what's the documentation requirement? What's the-
We're actually gonna get to that in that next little section right there. Oh, you're great, but now the next question is gonna cost you a ride in the car. All right, so, yeah, I'm gonna, all right, so record keeping requirements. We're talking about vehicles and we're gonna talk about mills next. Your requirement is if you do actual mileage, you do a lease, or you do actual expenses, you must keep mileage logs. If you get audited and you have no mileage log, your deduction will get thrown out, period. Now, I'd be lying if I said I never helped somebody create a mileage log out of their calendar, right? You got to have something. You got to be tracking where you're going, who you're seeing, so you can go, okay, I can create a Google map of, oh, I went to this house, I showed that property, I went here, and you can do it that way. They'll accept that, but you still have to keep a record of where you went and what you did to be able to do that. I prefer you just keep a mileage log. These days, there's so many great apps like MileIQ. It's inexpensive to do it. And you tell it, I'm leaving my office to go on a work trip. And when I'm done, and it calculates your mileage, it gives you a report via PDF every month, and then you're done, right? Do you use something like that?
I use my IQ, but I don't always take the car I normally drive for business. So if I'm showing a piece of property that's outside of Surprise and it's full of gravel and rocks, I'm not going to take a little Mercedes, I'm going to take my SUV.
Right.
So,
You are required to track it by vehicle.
okay, so I'm not finding, maybe I'm just missing that in the app. So,
Maybe if you just take your SUV once in a while, you track that one by hand. And then use the mile IQ for your primary business
I can
vehicle.
definitely look
Yeah.
at address and.
Yeah,
know.
yeah, I mean, and it's okay, like if you know, hey, I'm going to show this property in Surprise and it's 34 miles round trip, mark it in your calendar, note it, and you're good. It's not the end of the world. The IRS says you must keep pristine records for at least 3 months out of the year. They call it the 90-day rule. And they need to be 3 disjointed months. It shouldn't be January, February, March. It should be a spread over the year, because if you take that number and you extrapolate it over the whole year, and then as long as you have your beginning and ending odometer, they'll accept that. That's the minimum amount you can do, because it's burdensome, right? But if those 3 months that you do, you extrapolate out for the whole year and it comes out to more miles than you put on your vehicle,
Oops.
that's problem. So that's when it doesn't work terribly well, but you can do it, right? So I prefer a mileage log or an app like that. You can use your calendar to maintain that information, but in some capacity, you have to be noting it. So if you need to support it, you can. If you can't support it, that and meals are the 2 things. If you can't support what you did, you'll lose the deduction. They won't let you estimate it. They won't let you say, oh, this is based on last year. No, sorry, not going to work on an audit. Maybe with a great CPA, we can help you get away with that. But generally speaking, you can't win that argument. So
One more question.
Yes.
And you actually, I think, just answered it, but I want to make sure she knows that we're answering it. The question is, can you keep mileage for 1 quarter and use that as an average for the year?
yeah, it can be 3 months. It just has to be spread out. It can't be just 1 quarter of the year.
Just making sure she knows we got it.
Right. So
Thank you.
meals and entertainment, right? So entertainment is no longer deductible in the slightest, so don't do it unless you really want to, but it's just not going to be deductible. This year, meals are 100% deductible just for 2021. No 50% exclusion. So just know that. Again, meals are 100% deductible this year. Meals are one of those things that's always 50% deductible, right? This year's 100%.
Now you tell us, it's almost over.
I just mentioned the game. So I'm telling you, the moment I met you, doesn't that make me valuable? All right. So, but your record keeping requirement for meals is kind of like mileage. You have to note who you went with and what you discussed. Now, I'm going to take Jim, who works me out for lunch after this, and it's going to be a deductible meal. I'm going to write lunch with Jim. He's my team member. We're going to debrief about today. We might talk about a client. We might talk about Corvettes. I don't really know. It doesn't matter. So you guys have to be in the business of tracking who you took out. Now, obviously, if it's someone's in your client roster, you need to write down, talk about the house we just looked at. I don't care. But you need to note that, because again, under audit, you'd be forced to show them, here's all my meals that I deducted this year, and here's who I took out. It could be a business associate. You can take your broker out and get them, give you a ride in his Corvette. You can take out a client, a prospective client, all those sorts of things. Not an issue at all. Okay. Just have to document it. And there's no 90-day rule there. It's all year. So
Can you write, I was told that when you write notes on your receipts, it should be on the back, not on the front.
in 30 years of doing this, never once had an IRS auditor ever tell me that I couldn't do that. So I'm sure there's some attorney out there, any lawyers here too? Okay, no good. Some lawyer out there who said, you need to do that so you're not materially altering. I don't care. Doesn't make a difference, just note it. Now, there's some great apps that are free. One's called Smart Receipts. You can actually pay for that check, take a snapshot of it. You categorize it and put the amount in your app. Once a month, you print it to a PDF, email it to yourself. Now I've got all my receipts. I don't have to keep all the little receipts. Smart Receipts.
What was the one for the mile?
Mile IQ.
That is so amazing too,
Yeah.
because in the personal side, you put medical for Arizona.
Right. Exactly. Usually people complain, you know, that all the heat sensitive receipts, they fade over time. Sure they do. So if you take a picture of it, the IRS will accept it. If you have a PDF once a month for the whole year that has your handwritten notes and you've taken a photo of it, they accept that. They don't need the original. They just need to see it. So.
What about, I do gift baskets for closings,
Uh-huh.
and it's not really food, but I also give them bottle of champagne and a couple of flutes, and I like all that off or just the liquor?
You can, no, the whole thing you can, but here's the thing to remember. What's the limit for gifts?
75. or 95,
What did the IRS limit for gifts?
25.
Way over that.
Yeah, so here's what I'll tell you. I think
Put
it's
your logo on
ridiculous
it.
and archaic. It's absolutely archaic. Well, putting your logo on it's pretty smart, right? Because then it's promotional,
That's
right?
That's what I'm saying. We
Yeah.
think it's sticker on the bottom.
Right, and if you logo it, it's now a promotional item, and you put in your promotion expense, which is the next item on there, promotion. If you stuff that, it has your name, your business card and all that, you can call it promotion and just gifts in that category. Now, we have clients that go way over $25 per gift, and aviary has their own limits and the IRS has their own limits. Just don't be egregious. You know, if you have 200 grand in commissions and you have $5,000 in gifts for closing, I'm not gonna blink at it, but you show me 20, well, that's a problem, right? So we look at everything within reason to that in the bigger picture, right? So, yeah, you just have to be really smart about what you do with everything. And the more you can call promotion, the better off you are in a lot of different ways. Back when meals were only 50% deductible, I'll tell agents, well, if you're meeting with the prospect and you're promoting your business, it's not a meal, right? You just have to think about it. Maybe if you do something like you do a group thing where you say, I'm going to rent this classroom, I'm going to buy bagels and coffee, and they're all prospects. It's promotion, it's marketing, it's not a meal.
I do client parties though, too, so that,
Oh, that's meals and entertainment right there. You can't get away with that.
you can't get what.
You still, I mean, that now it's 100% deductible, but in the normal times it would only be 50%.
But it's still 50%.
Yeah. Yeah. It's just, again, watch the entertainment. Now, yeah.
What part of that would not be deductible? If you're having clients over, just the food, you're buying the food.
Food, the beverages, the cigars, the scotch, all that's good.
Cigars and scotch.
Yeah, right. That's all good, right? But if you gave them tickets to an event
No,
or took them someplace, right, then that's fine, as
But if
long
I
as it's
have
all.
Yeah, as long as the food and all of that
Mhm.
is only normally, I mean, I understand that this year it's 100%.
Right.
But normally, if I have a client party, then even if I buy food
Mhm.
and drinks and all that, it's only 50%.
Correct. Yeah, yeah. Right now, at that party, you go hire a DJ to entertain your clients. That part would not be deductible under the technicality of
I don't
it.
do that.
Yeah, I'm just saying.
What if I hired just because I wanted some music?
Same thing, that's entertainment. That's not a meal.
Just use your laptop and Apple too. That's what I do. Music, but I would like to.
But if you have the meals, have a DJ that takes pictures and put it on your social media, is that?
Oh, you're really getting pushing me. The answer I'm gonna be is maybe and see me after class, okay? I'm not gonna go on camera with
What if I
that.
put a
That's
logo
Yeah.
on there?
See, now you're just getting silly.
Well,
Well, now I have another question.
Yes, ma'am.
Because I do a lot of jam making, homemade jam making.
Uh-huh.
And when my clients come to my chili fest,
Mhm.
they get a jar of jam
Yeah.
of their choice to take home
Mhm.
with my name and.
Promotion and marketing.
That
That's fine.
promotional.
Is that
That's fine.
100%?
So if I buy food to feed them, or I take them to a restaurant, it's a meal. If I do something like that, it's promotion. Now-
Right, but see, what I have a hard time is because I've got a great big Remax balloon that I
Uh-huh.
like have at my party, so I
Uh-huh.
figured that that's promotional. That makes the whole party a promotional item.
That's, it's great. I mean, and that would really depend on the auditor. Or whether you can get away with that or not, because they're not all the same. Some will be like, yeah, that's cool. And then, no, it just depends. So that's really, really great. And so we can all push and do other things to get things to qualify as stuff. You just gotta watch how far you push.
Because well, really, at the end of the day, when we do those things, that's not only taking care of our clients, but it's promoting ourselves
I
as
understand.
well.
I don't disagree with you.
No, I know. I'm
If
just
up
trying
to
to
me, that would be
understand.
100% deductible, but there's some great, yes, sir.
Are there any stats on audits of individuals versus PLLC?
Generally speaking, no, there's not a real difference. You'll find that individuals with complex returns with Schedule Cs tend to be audited more in the general sense, but that's usually if they're using the Schedule C to generate losses offset other income. That's usually an audit trigger. So no.
If you're using Schedule E.
Yeah, the more complex your personal return, the more likely it is for you to get plucked for an audit. More components to your personal return, especially if you're driving losses.
The audits have pretty much hit
Yeah,
down low.
Yes.
There's this new administration wants to bring it way back up.
they do, and we're seeing it's probably not gonna
Yay.
happen. Yes, sir.
One other question came in, hiring a bartender and serving alcohol, does that qualify as food or entertainment?
Good idea.
If the bartender is like Tom Cruise in Cocktail and he's entertaining your guests, maybe not. I'd say you can probably get away with that as part of a food and beverage. Yeah.
Food and beverage.
So
Thank you.
that's super great though. We're slinging like waist high. We're not even knee deep.
Kind of making
We're
your own
waist high.
restaurant, you're still paying a tip. when it's served.
Yeah, but you're not in the business of being a restaurant, so,
That's why you hired a bartender.
right, but you're still not in the business of being a restaurant. I mean, great. But if you take those people, if you rent out a room at your favorite restaurant and then buy drinks and there's a bartender they're making, that's part of what you're paying for, that's all meals. So I would use that if I was trying to argue the case, I would use that argument to say it's no different than going to a restaurant. And overpaying, I'm gonna pay for the liquor myself and hire someone to make the drinks and pour for people. It's kind of the same thing.
So since it's such a big deal with this difference between promotional, do you have a list of things that qualify? for promotional?
Absolutely not.
Not?
100%. You will
called
never, ever
liability.
see me put that in writing. Ever. Kelly, did you ever see Melvin put something like that in writing?
Your dad never did that.
That's exactly. So no, we can't, and I won't, because there's too many if then what fors. So to give you a definitive list would be appropriate on my part, because depending on how you package it, it may count, it may not count. So it's more of a conversation than here's a definitive list. And that's fine. So I'd be misleading you if I provided you something like that, because I can't say in all circumstances.
So then how
that would
then do
work.
they get away with saying, oh, no, that's promotional or it's not?
It
if
depends
we-
on the
if we-
auditor on the other side. I mean,
And the CPA on the first side.
That's
or
right.
what?
I think of it this way, our job as a really good tax professional, who here's a football fan, all right, okay. My job is to be an all-star, superstar wide receiver. My job is, and the ball gets thrown to me, and I'm about to go out of bounds, I have the presence of mind to tap my feet in bounds before I fall out. So I look at it the same way as, what can I do that plants my feet in bounds, even if I'm stretching
But that's what I'm
the
asking.
situation? It depends on the situation. That's why you have to talk it through and say, in these set of circumstances, can we do X, Y, and Z? Because all the circumstances are different. So. yes, sir.
What percentage of your clients are out each year that you have?
We have not had an audit of one of our clients since 2006.
And it's very valuable.
Yeah. And that I'll give my dear departed father one bit of homage, which one thing he taught me was, this is how you present a tax return to keep from getting audited. And I can use the same numbers and report it 5 different ways. And sometimes the way you prepare it triggers the audit.
It's like that with everything.
Yeah, so presentation. So we look at a tax return, it's more like painting a beautiful picture. I'm trying to tell a story with a picture. And it has to fit that whatever story is I'm trying to tell. And preparing it a different way sometimes can tell the wrong story. So it's often in how you prepare it. Our audit rate is almost negligible. Negligent, wrong word. Negligible.
I was gonna say.
It's been a very long time. We just don't do
Speaking of
it.
presentation.
Right. I'll see you later, guys. All right, so real quick, let's talk about PLLCs and that sort of thing. So when agents often, especially when they're new, they're working as an independent contractor, which they're just doing a tax return as a Schedule C added onto their personal return. You guys have been there, done that, you've seen that. It opens you up for a substantive amount of liability, right? Your broker provides a certain amount of E&O coverage per transaction. It's usually 20 grand of coverage per transaction. If you want more than that, you got to do it on your own. Or you have form and operate through a PLLC to provide you additional legal protection. So if you do get sued, you could jettison your entity and relieve yourself of liability, right? So as long as they can't prove the intent to harm or fraud, right, then you're covered. One of the things that sometimes agents don't know, which I'm going to share with you, is how you utilize your PLLC. So number one, you have to have a separate bank account. Now, it doesn't matter if this is a Schedule C or an S corp, doesn't make a difference, we're the same. Separate bank account. You have to put a Trump-sized border brick wall in between your personal and business financial life. Everything business is paid the business account, personal stuff's paid the personal account. Money crossing over should be an over distribution or payroll, and that's it. The more you commingle, the more likely it is for your entity's corporate veil to get pierced if you ever got sued. If you're constantly paying your mortgage out of your business, right? That's a problem, or other business or a personal expense out of your business. They don't care so much the other way about business expenses being paid personally. I don't prefer it though. I tell clients, put money in your business account, pay the expense out of your business account. Number one, you can put your bank statements for the year and go through everything to get your taxes done. And you always have a concise reporting of everything that happened. But more important is you want to get that commingling to a minimum. The more you do this, the more likely it is that the corporate bill can appear, whether you have a corporation or an LLC tax of a corporation, or just an LLC Schedule C. So being super diligent is really important. The other thing is, how many of you know when you're signing a contract that if you have a PLLC, anything that you're doing as an agent, you're supposed to put comma PLLC next to your name? How many of you know that? Yeah. So the rules state when you get your PLLC, it's in the name of your license. Again, you could be in some other state, but they don't require that. Arizona does. You then go and change your license with ADRE that says, would say Kelly McLean, he has a PC, but PLLC. That means anytime you sign something as the agent, you have to sign the name on your license. If you don't do that, that transaction is not covered by your PLLC. Yeah, no, people don't realize that. That's just one of the technicalities of the rules. Now, if you're signing a check, no, you don't have to do that because you're just the owner of the business, right? But if it's signing a contract, signing an agreement, something where you're acting in the capacity of the agent, you must sign away your license. Each time, every time for that transaction to be included as part of your legal protection of your entity. Because then they would say, oh, Bob Smith, you signed that personally. That transaction is not covered by the legal protection of your entity, and that client is suing you. Now you're all open on this litigation, and there's probably nothing you can do about it.
Good to know.
Yeah. There, if I did nothing else today, maybe that's the tidbit y'all get for that.
Seth,
yes, sir.
we're gonna be wrapping up here in just a few minutes. I do have a question that came in. The question is, are there any last minute end of the year deductions to reduce taxable income to avoid jumping into the next tax bracket?
That is a fantastic question. So I'll cover that next. So I know we're short on time.
Sure.
Real quick, remember, if you guys are operating sole proprietorships and your net income is over 20-25 grand a year, you strongly want to consider getting into the S corporation for efficiency for self-employment tax. There's a big amount of savings you can have by not paying SE tax on all of your income. Remember, you're paying 15.3% as the owner and the employee essentially on the Schedule C. You go to an S corporation, you pay it on what we declare as reasonable compensation.
What's that benchmark?
20 to 25,000 of net income. And the reason is the money that I can save you in Social Security going to the S corp is about what it would cost you to do payroll and do a corporate tax return. So anything over about 25 grand, you've covered the costs from your savings. Now you're in the money. So if you netted $10,000 or $15,000, it would cost you more to go S corp than you're going to save in Social Security. So my job is to save it. So for year-end planning, one of the things that I kind of skipped over, and I don't know whether your CFP covered this last month, is retirement planning. I will never, ever tell someone to spend $1 to save 25 cents in tax. I'd rather have 75 cents in my pocket and have a nice day. If there's things you need to spend money on, you want to consider that, right? And you want to consider when to do it. But the thing, what we see people fail the most in is retirement contributions. None of you have employees, so you have the world of options available to you for retirement, right? The bad part of a Schedule C is any retirement contributions are still subject to Social Security. But if you're in an S corporation for tax purposes, if you do a SEP, which you can do up to 25% of your wages, tax deferred, and it's an expense in your corporate, you'll never pay Social Security on that money ever. If you do something like an owner's 401k, your employee deferrals would still be subject to Social Security, but your employer match, which is eligible for up to 25% of your salary, is free of Social Security. And it's all pre-tax for the future. Obviously, there's IRAs and things like that, but if your income level doesn't support it, then that's not an option, right? Those are the things I recommend people do is look at your retirement contributions first. You're having a great year. What do? Let's match your retirement opportunities. Right now in October, actually no, early November, if you wanted to do an owner's 401k and you don't currently have one, you still have time, but the clock is ticking really, really fast. Most brokers won't set one up after November. Can't get it done quick enough to get the money in there to fund it. A SEP IRA, which is a company sponsored plan, you can set up and fund as late as when you file your tax return this year. So you get your 2021 tax done and say, I want to get my tax bill done. I'm in retirement. You can start a SEP. You can fund it for up to 25% of wages in an S corp, or 25 or 20% of your Schedule C net income if you're working that way, and fund it as late as the day before you file your return.
You have a lot of agents, high incomes that are using defined benefit and profit sharing.
Don't often see agents do the defined benefit plans just because their income is so inconsistent. Defined benefit plans do require consistent funding over a number of years. And unless you're at the place where you're consistently performing at that level, it can actually create an undesired liability for you. Most often, our agents do either SEPs or they do owners 401ks with the deferral and a combination of the employee contribution. But we have clients that do defined benefit plans. They work very well, but you have to know that you have at least a minimum of a 3-year requirement to fund that plan. You can fund it and halt it, but the IRS does not like that. So really you have to have in your mind, I've got to be funding this for at least 3 years at some comparable level before I can shut it down and stop funding it. So that's why they typically don't do it, because you guys know your income's all over the place. You can have some great years, you can have some lean years. You don't want to be stuck making some big contribution. And if you're on lean, I don't have cash, it makes no sense. So we want to make sure we put you in a successful place, but that's possible. It just depends on your personal situation. So how much more time do I have?
Just a couple more minutes,
Okay.
I think is
A couple other things on here. We kind of talked about auto triggers a little bit already. What do you guys think the average expenses are for an agent as a percentage of income?
Third or gross.
A third, so 33%. What else? Okay.
For the average agent.
Okay, I will tell you statistically, it's about 25. We have enough. I've actually done our own statistical sampling of our own client base. I have enough across the board, and the average is hovers right around 25%. But here's what happens. The IRS knows this. So if you look at your tax return, whether it's a Schedule C or an S corp, you'll see a 6-digit code, a NACIS code, and it's 531-210. It's for real estate agents. It's one of the only ones I have memorized. Go figure. And they will take everybody with that code and put them in their godforsaken Unix computer. I mean, it's bad. And they will compare you to everybody that has the exact same code. That's where they come up with audits. If you're on the fringes, they're looking to see why. So your expenses go way over that average, you're much more likely to be audited, right? You're way under it, probably not so much, but if you're way under 25%, I say you're not reporting that. And what's most likely happening is either you're legitimately not spending money or you're forgetting about deductions, or you just kind of be coached on developing your business. So it depends. And our clients are, I'd say we generally hover low 20s to about 30%. I mean, I have some clients who are in the mid 30s for percentage of expenses. They're working super high end properties, lots of volume. And I look at, and it makes sense for them because I see what their marketing efforts are and all those sorts of things. But I tell them, be prepared. Make sure your documentation is pristine, because you're making more, you're spending more, and you're more likely to get that knock on the door. I mean, not if I do it right, but you know what I mean? It can happen. And some audits are random and some audits are, oh, you did something that looks really good. So, yes, sir.
Take income in this year or take it in next year?
Well, in an era where we know taxes are going up, we just don't know what it looks like yet. I'm encouraging clients to take income this year, push large deductions to next year. Now, income tax brackets may not end up changing as much as we think. Capital gains are definitely going to go up. We don't know how much. It depends how that support ends up in Congress by the time they're done negotiating all this baloney. But we know we're going up. So in an era we know taxes have to go up, we want to front load this year and push deductions next year, just to give you an arrow in the quiver to kind of offset some of that. So if you jump from 32% tax bracket to 36 because they just tap the brackets, that deduction next year is worth 4% more. So why not strategically plan for that when you can? So we still got to do retirement planning in the current year, right? So contributions for SEPs and IRAs and 401ks should happen in the current year because you can't really defer those. But for anything else, it's a purchase decision, whether it's a vehicle, it's office equipment, whatever it is. You know, obviously you guys, your cars are your biggest expense. So that's always the biggest strategy for an agent is how do you manage that? So.
This has been incredible.
Yeah.
Thank
Yeah.
you.
You're welcome. Thanks,
Great job. That's worth the right for you.
Great to have you.
That's worth the driving for that. What I do have up here, guys, is I have some packets on our firm. So what I didn't share with you is we are, like I said, a complete holistic planning firm. I have just a little brochures on different parts of the firm and what we do. If you like one, you can grab one on your way out. And I can leave the rest with you. So if anybody else is interested.
Yeah, I'll take it back to the office. Now, will you be able to hang out for a few
Yes,
minutes
absolutely.
to talk to
Absolutely.
people afterwards?
You got it.
Wonderful. All right. Well, make sure you write down their information at the on the screen there, and as you just heard, they're going to hang around to answer some other questions for if you have them. And everybody's situation could be a little bit unique. So if you want to kind of listen in or whatever, I'm sure that could be okay. Or
I will
if you
tell
want to
you
have a
it's-
private conversation, give them a call.
It's focuscompanies.com.
Oh, shoot. I'll make sure we get that updated when
No
we send it out to all
problem.
the
No problem.
agents. So, thank you. Now, Jen and Troy, you have an event coming up this week that you wanted to talk about. I'm sorry, next week on the 17th. And Jen had a little bit of other information to share as well.
She just made everybody look at that. You know that, right?
All right, well, good morning, everybody. Jen Weller. Hello to everybody online. So in case you guys need any CE credits, we have a CE class next week on Zoom for agency. It's with AmeriFirst, and it's going to be from 1 to 4 on Wednesday, Dana Booth. So again, it's agency. This one's a little different. The link is just a Zoom link, so you have to just email me or Dane Jensen to RSVP. You can just send it to me and I can forward it in. But that's next Wednesday. My last class personally that I need, so I'm really excited to get this one done so I can just be done for the year. And then one other thing I wanted to mention, you guys, in case you don't know, we were talking about this in our managers meeting yesterday, which is the first one we've had in almost 2 years in person. But for any closings at the end of the month, just so you know, the recorder's office is closed on December 31st. Fidelity is open, the banks are open, but you cannot close on the 31st because the recorder's office is closed. So I would highly recommend you make it for the 30th or even the 29th in case there's any issues. You have a pad time, because otherwise your closing date will be January 4th because of New Year's. So just remember that, because
That's a big deal.
it is, and that's a long time where you can't move. So-
And an idea to go along with that, coming from outside the industry, I always went, why do we close everything on the 30th of the last day of the month? There's not really a good reason for that. So when you close on the last day of the month, you're up against everybody else that is trying to close on the last day of the month. So I don't know, I'm guessing a lot of you probably stay away from that, but if you don't, consider staying away from the last day of the month, or the last days. You get, regardless of the company, you're gonna get better service, less activity if you're different days in the month, because everybody's pushing to the end of the month. So just kind of a little tidbit on any month.
And we were just talking about that yesterday, because it's not just escrow that's busier at the end of the month. The movers are busier at the end of the month. They probably are more expensive at the end of the month. All the little things.
Mortgage,
You need a lockbox or a key change at the house, or, you know, anything at the last minute, end of the month is always going to be tougher. So a lot of people do it in the middle of the month just to make everyone's life
Midweek,
easier.
mid-month.
Yes,
Yeah.
always recommend,
Yeah.
don't close on a Friday. So that's all I have. So.
That's
Did you
great,
say
great
that the
advice.
recorder's office is closed the end of this month?
No, not this month, the end of so December 31st. So December 31st, they're closed, so you wouldn't close till the 4th.
Well, some
Next year.
lenders also will not sign in 1 year and fund in the next, so everything has to be within that year. In fact, most lenders,
That can get messy.
well, they'll push your closing.
Yeah,
So even if you have it for the 28th or 29th, if they're at risk of funding in the next year, they're gonna push it to the next year.
and a lot of people like to take off around that time, so it's gonna be lighter staff anyway, the last week of the year, so.
Yeah, and even though we're hearing that banks are open on the 31st and the 3rd, which is the Friday and the Monday, the back to the quarters is not. So, you know, just kind of know that going into this year for end of the month, December. Yeah.
Thank you.
One little idea, you know, especially if you guys think coming from North Dakota, if you're from another market, you might consider farming, if you will, people that have second homes here that is from specifically that market. Got some ideas around that, ways to get you lists and stuff. So if you're, you know, most of us are from somewhere else. It's a great way to build rapport quicker, sooner, because everybody that lives here in North Dakota from Williston, immediately you just got your leg up, right? Because I'm one of you. So just an idea. If you're looking for kind of getting a farm of listings based on where you're from.
And happy Veterans Day, and if anyone a veteran in the room? Thank you for your service.
Thank you very much, Jen. Gary, and then we'll wrap this up for you. Thanks for hanging in a little longer.
Okay, just got a minute or two, a couple things I should say, a minute or two. Idea that I,
Hey, Gary, can you come to the microphone so they can hear you?
idea I came across through watching a couple different things on Facebook and then another class or seminar I was sort of on. With Zillow, OfferPad and all them sort of doing fire sales and stuff right now. A good way to try to find some of those properties is go into Monsoon. Pick a zip code that you might have a buyer looking in, put in Zillow, OfferPad, or Open Door. And you'd be surprised what comes up. It will show ones they just recently, like I got a client right now that I'm doing this with. It'll show what they just purchased. It'll also show what they have for sale. Nice thing about that, you can also then click and see what they actually paid for it. There's a lot of Zillow properties right now that I'm just gonna grab numbers. They paid 600 for, they're on the market for 520, 525. So just an idea on that. And then some house cleaning or keeping, I should say. We are trying to clean up our unclosed files. More than likely, you're going to get requests for things that you've gotten requests for documents on numerous times. Depending on how many times we haven't been responded by an agent, we may be having to say, hey, we need these documents before you get your next commission check. It's things that Arizona Department of Real Estate requires is in the file. As an example, earnest deposit receipt. We have to have an earnest deposit receipt in the file. The file gets audited, I'm in trouble. We have to have a closing statement in there or a escrow cancellation statement because we have to keep track of where that earnest deposit went. Closing statement takes care of it because it shows that it went towards down payment, it closed, it went to the seller, it went to costs, whatever. Title cancellation shows that if the escrow closes, or I'm sorry, cancels, did the seller get it? Did the buyer get it? We've taken care of keeping track where the money is. But there's a lot of other stuff that you're good chance, some of you are clean. There's nothing whatsoever that needs to be taken care of. Others, there's a lot of files, a lot of old stuff. I mean, I'm searching for some stuff right now. ADR says I have to keep track of stuff for 5 years. I'm going back 4 or 5 years right now, and I got files, and some agents I probably have sent 10 requests for those documents. And the kicker is, you as agents, if a transaction closes, you also have to keep your documents for 5 years. So it's not like I'm trying to be the hard guy, because if they audit that file, I don't have it. Pretty sure they're going to come to the agent and say, hey, do you have it also? Because again, we are a income producing entity for the state. Arizona Department of Real Estate is an income producing entity for the state. They are finding people, they are going after income and going with fines.
Now that we're online with all the record keeping for files.
Howard, please speak up so that
The ADRE can actually go into our files without us knowing. And that's part of the permission we grant them. Be careful of what you send back to Gary as a response to his request for information. If you say, screw you, I'm not doing it, you could probably lose your license. Lose your job. We don't want this to be the last place you ever work.
And that's a great lead in also, similar to your list.
By the way, we have people do that.
Really? Similar to your list, you don't produce it. You guys, anything you text, anything you send email, it's there forever. Okay, if they are auditing a file, you get a complaint filed against you and they're coming in and they're wanting proof. And they're going to subpoena your email records, and somewhere in that email record has something you stating that you shouldn't be stating. You're going to potentially get an additional charge or additional issues that you're going to have to deal with. So if you're ever in a dispute with somebody, a disagreement with the agent on the other side, you're not happy with your client, pick up the phone, call them. Don't text them. Don't send an email, because those will come back and haunt. Other than that, that's it. Any questions you guys have?
Thanks for all you've done for us. Yeah.
Just one last announcement. December 7th at Greyhawk Golf Club is going to be our company holiday party. It's from 4 to 7 on the 7th, which is a Tuesday. We're gonna have some music and hopefully working on some other little surprises here. I don't want to say anything just yet, but it's gonna be a great event, RSVPing and things like that. You'll get that information probably more times than you want. So just hang tight, we'll get it all to you. But if you want to mark down that date on your calendar, December 7th, between 4 and 7 p.m., that's when we're gonna have our holiday party in Tucson for our Tucson associates. We should have an announcement out today for our Tucson event. So any other questions for myself, Howard, Gary, our guests? Yes, Sally.
I don't necessarily have a question, I guess I do know what, anybody needs a property manager, that's what I do for the last 15 years, and I would love to do property management. I have a lot of the agents who will refer me. I just got one today, another one, so I would love to work with you.
Thank you very much.
I've got one.
Yeah. Come on up, Howard. So
This
I'll hear
is,
you.
well, this is the time of year that agents are deciding whether or not they want to continue being a realtor. We've got an oversupply of active agents in the market, 46,000, of which about 15% of them actually made a good living this year. You know, best market ever. So if anybody mentions that I really wonder if I should be in the business as an active agent anymore, don't let them give up their license. Have them join my referral only company and refer business to you. Instead of sharing bad information with their best friends occasionally, let them use you as a professional and join the referral only company. No fees to join, nothing to remain. You don't have to pay any NAR, AAR, RRR, none of the R's have to be paid. You just refer business and get paid. It could not be any easier. So, but January 1st, all the dues come due, and it's hundreds of dollars for no apparent reason for a lot of people. Very good. Thank you.
Well, thank you again, everybody, for being a part of our meeting today. And for those of you that tuned in online, all the materials and everything are going to get emailed out in Gary's email later today. So you can review this later if you choose, download the information, so on and so forth. So with that being said, we hope to see you on the 7th and look forward to helping you. Let's finish this year strong.
Isn't that gross? It was over here and I switched them.
That's awesome. I've already
We made
got
some
other
progress
people
since we've been back. We got everything we needed. I know. I know.
saying. Thank you very much.
So busy. So it's a good time.